Perhaps the most famous stock market bubble was Wall Street's 1929 crash. Following a victory in World War I and a wave of new technologies which were emerging from the factories of America, including things like radios, cars, nylon, etc., investors flooded into the US stock market. Um, at this time as well, the first public investment funds were being sold to people in America for the first time. These funds often had very poor disclosure and were using excessive amounts of leverage. Unlike the mutual funds that we have today, these types of closed-ended funds were very active in using a lot of borrowed money in order to enhance their returns. The problem was that individual people were taking out leverage in order to invest in these leveraged closed-ended funds. And because the disclosure of these funds was so poor, people didn't realize that the returns on their trusts they were investing in would be further multiplied above and beyond the leverage they had already taken. So an individual that bought into an investment fund using 3 times leverage and then ultimately found that the investment fund was also 3 times leveraged would suddenly end up with 9 times the amount of leverage on their investments, meaning that a decline in prices of even just 11% would effectively wipe out their positions. So these were rather significant issues. You had new opportunities being made available to investors. You had enormous amounts of margin loans that were being made to the tune of 1929, $8 billion, which had been lent specifically for investments in securities, compared to the total of $16 billion worth of national debt that the country had. It's interesting to see why it is that banks might have wanted to make these kinds of risky loans, because at the end of the day, they were lending out margin loans at a rate of 10% while financing it with 3.5% loans themselves, capturing a 6.5% spread on every dollar that had been borrowed for investment purposes. No bank would want to stop this train from happening. And so as a result, they were willing to extend more and more credit to people along the way, hoping that prices would only move in one direction. The third issue, of course, is that the stock market that's roaring to life like this attracts a lot of unscrupulous types. For instance, one company that was trying to raise money at the height of the boom said that it was an airline, when in fact it was a railroad. Another one promised to sell prime building land in the middle of the Florida Everglades, in case you're unaware, a snake and alligator-filled swamp. Other companies which were sold to the public didn't exist, frankly, except entirely on paper. So this has a rather predictable result now that we've been able to look back at the history of a few different bubbles. After the market rose 50% in 1 year from October 1928 to 1929, the market collapsed, reversing all of those gains in just 6 weeks, including a catastrophic Black Friday plunge over October 28th, 29, which resulted in 1/4 of the market losing its value. Now, remember, a lot of people at the time were deeply leveraged, and many of the funds were deeply leveraged, meaning that they were not only wiped out themselves, but that there was no way they could possibly cover the margin loans that had been extended to them. And this, of course, led to the insolvency of many banks, which then cascaded through to other lenders. Even though the United States had a central bank in place to act as a lender of last resort, the relatively new Federal Reserve System bungled the response entirely and actually raised interest rates in an effort to try to keep capital in the banking system. So to stem a bank run, and to encourage people not to withdraw money, they raised interest rates. And while that may have kept some money in the banks, the healthy ones anyways, what it did do was drive a number of businesses into bankruptcy. On top of it all, the US government decided that the best response was to try to raise tariffs and trade barriers to try to make sure that business stayed within America, which ended up ultimately raising unemployment throughout the country as a number of international connections between nations were lost. Between the fumbling of the Federal Reserve and the mistaken policies of the federal government, the stock market crash ultimately cascaded into one of the worst economic crises of the 20th century, the Great Depression. Now, the reason this is an important stock market bubble for us to consider is because of the regulatory response which followed. Unlike the 1720 bubble 2 centuries before, the government simply didn't ban new shares from being traded and instead decided to reform the stock market rather than trying to put it back into a box effectively. And this meant introducing a number of new rules: tighter limits on margin lending, restrictions on mutual fund strategies and the amount of leverage that they could take on, some more stringent disclosure requirements, both of companies and funds, and stricter regulation of the behaviors of both brokers and dealers. Today's markets, it's worth noting, are much more heavily regulated than the markets of even just 100 years ago. And almost all markets have some kind of supervisor in place to monitor trading activities and to prosecute securities fraud. There are a number of different kinds of activities which we have been deemed by regulators to be prohibited by brokers. These include things like front running, bucketing, pump and dump scams, and wash trades. Interestingly enough, they also passed laws forbidding insider trading. In the 19th century, it had been regarded as standard that people would only want to trade with inside information. And of course, it wasn't illegal at the time. But today, we've largely decided that insiders should not necessarily hold an advantage over outside shareholders, that the playing field should be more leveled and safer for the average user. And so the regulatory response to the 1929 crash is perhaps more important than using it as a taxonomical tool to understand other bubbles better.